Enbridge is today's topic, and if you're here, you most likely already are or looking to invest into that sweet, fat, juicy 8% annual dividend paid by Enbridge. So in today's video, we're going to be determining if Enbridge is overvalued or a potential buying opportunity for those sweet dividends. So the way we're going to be doing that is we're going to be using two models. We're going to be using the DCF, which is the cash flow prediction model, and DDM, which is based off of the dividend growth of the company. So if that interests you, stay tuned and let's get right to it. So to start things off with, we're going to be just focusing on the highlights page, and I want to draw your attention to year-to-date performance on track and guidance reaffirmed. So let's just take a quick look at what 2023 guidance was and what 2024 guidance is. And you're going to see here the 2023 financial guidance has two things that we're going to zero in on, which is DCF share and dividends per share. So you're going to see here a 5% compound annual growth rate prediction, as well as a 3% compound annual growth rate for the dividends. Now, if you're familiar with Enbridge, you will already know that Enbridge just increased their dividends by 3.2%, which increased from 3.55 to 3.66. Now, if you're already an investor, your thumbs up. Everyone likes dividend increases for sure. Now, again, these are predictions. So let's just kind of now move over to the 2024 to kind of see how things still line up. So looking at the DCF share, you'll see how there is a slight change. We went from 5% compound annual growth rate down to 4%, but the dividends has remained strong at the 3% compound annual growth rate. So why is this important? Well, in the DCF and the DDM, it's always important to it's really easy to know what the past history was, right? We can take that data, we can figure it out, and it's very simple. Now, in the model, the one portion is the predictions, right? How is it going to grow? What is it growing by? Because it's obviously impossible for us to know indefinitely, but this is why we need to use the guidance in order to figure out where the company is potentially going. Now, again, it's all a prediction. It could be really bad or way better or right on par with the guidance. We don't actually know. And so the intrinsic value, which we're going to determine here shortly, needs to be taken with a grain of salt, right? So the other thing is when we're doing these models, it's always very important to be confident behind the numbers that we're using, right? Because if we're not confident about it, well, are we really going to believe the numbers? So that's what we're just going to kind of look over here in the next little bit of this video. So again, just drawing attention to the DCF share guidance being at 5.25 to 5.65. So again, these numbers are based off of their Q3 year to date, and you'll see here that their last reporting was 4.2. Now, you might be thinking, well, their actual annual report is going to be coming out shortly, and that is true. So what we're going to be doing is we're doing this video first, and then we're going to kind of do a shore up on their actual annual report and kind of see how these things continue to line up, what adjustments are being made, and see how that affects the intrinsic value. So if that interests you, definitely smash that subscribe button for that future content and like this video. So confidence, right? So I'm pretty sure that, come the next quarterly report, they are going to be within that 5.25 and that 5.65. I'm going to guess more on the lower side though, compared to the high side, but it's again, magic 8 ball. It's just a prediction. But again, just kind of building that confidence. So also in regards to confidence, because we're going to be doing the DDM model, is I want to point out, if you're new to Enbridge and you're looking to invest, Enbridge has paid out 28 years of dividend increases. Now, they've paid out, I think it's either 70 or 71 years total of dividends, but the last 28 of them have been increased each year. So what does that mean? Well, I want to just highlight on this because, again, when it comes to confidence between our, with our numbers, as well as everyone's a little wishy-washy on our current state of the economy, right? Are we going into a recession? Are we already in a recession? Did we have a soft landing? No one really knows, right? It's always it's always a magic 8 ball. Again, I'm going to say that lots throughout this whole video, and I apologize, but I want to just kind of highlight here. Now, first of all, this is just missing data. They did pay dividends between 2012 and 2013, so that's just an error on the website. But looking at the 2008 financial crisis, you can see here they went into it paying 15 cents. They increased it to 17 cents during, and coming out of the crisis paying 19 cents and 21 cents. Now, another kind of time frame that was a little hard on the economy was around 2018. Again, went into it at 61 cents, during at 67 cents, and post being at 74 cents. So the reason why I'm showing you this is just, again, to reaffirm confidence in Enbridge. During hard times, the company has had no struggles in paying out their dividends and increasing them. Always important to recognize that, right? So another important metric in regards to dividends is the payout ratio. Now, again, people are on Reddit and all these places talking about how Enbridge is paying out over 100% payout ratio and it's not safe. Well, if you don't understand an infrastructure-based company, it can definitely freak you out. But when you look at Enbridge, or you look at a company like TELUS or Bell Canada, which are very infrastructure heavy, they get to use a lot of depreciation on their assets, which then on the financial statement brings down their earnings, but even though they still had like lots of free cash flow. So what I did here is I just took what their net cash operating activities were from the Q3 of their report, and used their current payout of $2.67 and used their current outstanding shares, which works out to be 55% payout ratio. Okay, so a lot different than over 100%. Now, depending on how you do this calculation, it will change the number. So some people will base it off of like their DCF or other models as well. I think if you use like the other models, it'll come in at around that 62%. So I just kind of want to highlight that there could be some slight differences. But whether it's 55 or 62, again, very safe. Now, I'm pretty sure I saw in their guidance that their aim is to have a dividend payout between 60 and 70%. So again, if it is that 62% that you're going to base it off of, then of course it is actually right in line with what the company is looking to achieve. So again, all safe, all good numbers, no concern in my personal opinion. So let's get right down to the cash flow intrinsic value. Okay, so again, we're going to also do the DDM, and then we're going to combine them to kind of get a final number. But you'll see here, we are taking the 4% that everyone, is what guidance is kind of relaying, right? So 4%, it was 5% in 2013 or 2023, changed to 4% in 2024. So that's what we're going to use, is the 4%. And if you do the math and the result comes in at an intrinsic value of $74 per share, which is unreal high. But if you're also familiar with these models, this is a very simple model, and you could have models that take months to construct. Now, so that's why we're going to use the 20. A lot of people in these particular simplified models will use like about a 20% safety margin. So again, if you take that 20%, it comes in at $59. Now, again, very high compared to what the current price is at $46. But we still haven't done the DDM yet, so we have to take the combined averages. So just hang tight. So now kind of going into the dividend one, where you'll see here how I've labeled out their dividend payout over the course of the number of years and what the growth has been per year. And so you'll see how their past 5 years has been 5.82% on average. But we're going to be using the 3%. Again, if you look at the 2023 and the 2024 guidance, we're at that 3% compound annual growth rate. So those numbers come in at definitely lower, right? So the actual intrinsic value price comes in at $52.29, and with the safety margin being at $41.83. So if you actually take the combined averages, we're coming in at a combined average of $50 per share. So right now, the current price is at 46. So not a great stock appreciation. We're talking 3 or 4%, but we can't forget about the dividends, right? We're going to get into that here shortly, but I just kind of want to quickly highlight also how Morningstar has come out with their consider buying opportunities. And you'll see Enbridge kind of right at the top of the list. and showing that their fair value in Canadian is $52. So they are labeling Enbridge as a buying opportunity, and it is kind of in line with what our intrinsic value is coming in at $50, right? So again, take everything with a grain of salt. Doesn't necessarily mean that it's going to be $50 in the next couple of days, but this is where the stock price should be kind of going to, in theory, if all the guidances become true. Again, the models though cannot predict, market conditions or anything like that. So again, take it all with a grain of salt. I'm gonna use the word again, magic 8 ball. So moving forward, I kind of wanted to figure out, okay, so what was the past 5 years of performance? Because if you look at the current stock price, where the guidance is, and where the future stock price will potentially be, can we use past history for the future? Now, typically I say, the past history, no, you can't bank off of that. But I just kind of want to use it as a bit of an example, right? So looking from January of 2019 to January of 2024, you'll see here that Enbridge did get a 9.39% compound annual growth rate. Now, I don't necessarily believe that we're going to get the exact past 5 years in the next 5 years. If anything, I would probably expect it to be slightly lower, so maybe in and around that 8 to 9% compound annual growth rate when you factor in the stock appreciation and the dividends. But this makes me really curious. I want you to leave a comment below. What are you doing? Are you selling? Are you buying? Are you holding? Are you seeking other investment opportunities other than Enbridge? Like I said, I'd be very curious to know, and I look forward to seeing you guys in the next one. Check you later.